All right, so stocks continued a very sideways move today. Not very much of a gain, but at least it held most of yesterday's gain, even if we broke into that opening gap from yesterday a little bit at the open today. So it's we held up strong. We didn't follow through very much, but we didn't also break down either. So we're still maintaining some bullishness. How much longer and how much further are the big questions, right? And how does that impact what I do on a short-term active basis versus what I do with my long-term expectations, which we've talked about before, very strongly bullish, but are my short-term expectations just as strongly bullish as my long-terms are? So we're going to talk about that, how that impacts the type of trades we do, and even with some of the froth. Some of you may be surprised at what our trade idea of the day is. We're going to take advantage of a pretty decent looking chart and a breakout candidate in today's video. So let's go ahead and get started. Today is Wednesday, December the 2nd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's check out the market forecast indicator on the S&P 500 first, as we always do. We take a look. We got strong bullish posture. The intermediate line well up above 90 at the 96th percentile there. Obviously, maintaining good strength above the 30-day moving average. Well up above, and you can. I mean, look how long we were above it for quite a while there. So pretty decent distance now, culminated in this cluster, and then not so good, right? So we'll see how things turn out, and but still, we're going in the bullish direction, obviously here. The near-term line set up for even another divergence, right? We had this divergence, the lower highs in the near-term line with slightly higher highs here. A lot more pronounced in the Russell 2000, right? We had much higher highs with the lower highs, but the Russell 2000 has not been nearly as bullish in the last few days as the S&P has. You can see its near-term line is barely above 50, and even with the market sentiment actually above 80, but its near-term line is barely above 50. The S&P's market sentiment, so it's still kind of a longer term run that is barely coming out of sideways run that brought it down below 50, but you can see its near term line is well above 80. So a lot better last couple of days than what we've seen on the Russell 2000, but still divergence there, just not as pronounced. And then you got potentially lower highs as of right now on the near term line, with obviously a higher high. A little bit more of an obvious higher high than what these previous two that culminated with that cluster there. Remember, the Russell 2000, the first high point in its near-term divergence was a cluster, and then we got this one, and now setting up for still bullish lows. These are all these were bullish low points, but setting up for the possibility of another bullish or bearish divergence. You can see that what we got on Monday, we talked about that bullish intermediate confirmation signal. We did bounce off of that low, as you would expect with that pattern. We haven't bounced up very much, so we'll see how whether or not the near-term line can make a run up above 80, and if we do, we end up with a bullish cluster with all four lines, which is pretty rare. Obviously, we didn't get one over here when the market sentiment line was up above at 80. And we talked about before, again, how far above the 30-day moving average we are, and how that usually means we come back to it. Doesn't mean we have to drop. Here we just went sideways, the moving average caught up to it. But in some of these others, where we did really get extended away, we did drop down to it. So we'll see how things play out there. It's probably more the likely scenario that we have not a 3-day drop or big declines, but more of a gradual move lower, maybe even something like that, where we just kind of gradually move lower. Then we get a bullish pattern, we bounce back up. The NASDAQ composite got the cluster yesterday. Right? We got that overbought cluster yesterday. Really good gap up to the upside yesterday, to the point where we did close on the NASDAQ. The high point here, 12,440, was a kind of a what are those, tombstone hanging man pattern there, 12,439. Well, yesterday we closed at 12,455, and today 456. So smidgen up above that 100% line, Let's see if we hold it. See, that time when we got a smidgen above it, we didn't hold it. This time when we got a smidgen above the 78, we didn't hold it. Now we did break the 78 with all these gaps that have yet to fill in. But now we're a smidgen above the 100 line. And we'll see if we end up holding that one again. You know, especially with a cluster, it's unlikely. More likely we might pull back towards that moving average. But regardless, we've had a nice, good bullish run. And even if maybe some, you know, and we've been making some bullish trades in these videos and in our options classes that I have, trading rooms that we have at Market Scholars. We've been gradually making some more bullish trades. We're not heavy bullish deltas, but we've been gradually making more, and we'll make another one today. But even if your active trading portfolio might not be strongly bullish, as we've talked about before, the long-term portfolio is very strongly bullish. You know, we've got different weightings in different areas, and we got, you know, according to our benchmark, we have different focuses, but still we are all in on the risk appetite mode going forward from here, especially in the long term. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our icon, this icon right here. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are uploaded and posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked the video today and that you want us to do another video again tomorrow. Quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch us. But if you do like our videos and you want to let us know, one click. We really appreciate that, and it does us a big benefit because it promotes our YouTube, sees the engagements, and promotes our content. So we really appreciate that. Also, while you're down there, comment. What stood out to you in the video today? What did you get out of it? What questions or comments do you have about anything I talk about? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle up there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, come down here over to the right and you can see some of the other things we have going on, including recent posts on our blog and our upcoming classes, including Brandon's Q&A session that he has tomorrow morning. We also have our Market Outlook live videos. I review all the trade ideas I do and all the previous Market Outlooks. So if we need to close any or manage any, we talk about that. Every day I do the Market Outlook. I do a live video on YouTube at 3:30 Eastern Time. So check that out there. Also, come down here, hit this hard. Look at that. We got the 100. I'd love to see triple digits on this. Click on that hard. It opens up a new tab. Hit that like button. Also, come over here, hit the thumbs up icon. Also opens up a new tab for your Facebook page. Click the like button there. Again, this really benefits us because it promotes our content to all of our followers, not just not just the 100 or so that see this typically, because we have a lot more than that follow the material here, our accounts. So it benefits us. But it also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, let's take a look at some of these longer term charts. Let's see the weekly chart, and you can see a great Hakinashi candle. So 2 more days into the week. Now we're almost closing above last week's highs. In fact, we're closing almost above all these 3 weeks highs. So really good bullish candle from that regard. Higher high, obviously. We did finally break through to a higher high finally. Obviously a much higher close, and that's probably going to end up being the case. It's pretty hard to move that close because it's the average of 4 prices, the open, high, low, and close of the week, of the normal candle, right? So most likely we're going to finish with a higher close, and most likely, 35.68, that's 100 points away. So we'd have to really drop 100 points or more in 2 days to get a lower shadow, which is unlikely. So we're going to end up with a pretty decent bullish candle here this week, and a little bit of a kind of a breakout after really getting smaller. It is relatively small, and keep in mind the PPO is still pretty darn high. It's one of the highest that we've had, as I think I shared with you on Monday. When you look at the PPO here of that 1040 cross, obviously it's the highest that we've had in the last 5 years, which includes that peak in 2018, which was insane, and even this year's. And this is a relative PPO. It's not high because the index is a higher value. It's apples to apples across its history. So if I were to go back to 20 years, which again includes, two bear markets and a really strong bull market here. We're in the 98th and a half percentile, the PPO. There's only been a few other instances higher than where we are now, and that was coming off of these lows. And even at those peaks, we still tested the 200-day moving average after getting the golden crossover. And remember, we just haven't done that yet. So doesn't mean that we won't ever do that. Keep that in mind. It doesn't mean we have to do it next week. It just, you typically test the 200-day moving average after a golden cross, especially when when you are this darn bullish, right? In this case, about 7%, we still made a retest of those 200-day moving averages. Even over here in 2011, we retested. We didn't have a golden cross, but we came pretty darn close to a death cross here in 2010. So it kind of gives you an idea just how strong we are right now. And we've seen in the recent past, for those with shorter memories, other instances where we're kind of parabolic, especially in January of 18, and we're strong. We have stronger momentum now than we did even then. Now, granted, we were a lot further along in the golden cross then than we are now, so a little different scenario there. But needless to say, right, we are pretty strong, and the 3 green arrows. Again, I mentioned it's going to be very hard. I think I mentioned this. I can't remember if I mentioned this in our class. It's going to be very hard for that MACD to pull away from the orange line, from its moving average, which is what makes the histogram go up. So the histogram, because both lines are already pretty darn high, the histogram is going to stay flat at best, right? If not pull back, so that you can get this kind. See, you get the strong MACD hills when the MACD is coming from a lower negative level, even if it's only slightly negative. And that wasn't that big of a hill on the MACD, is more of a grind, but it's pretty darn bullish, even if the MACD mountain never got as big as this one did, because we came from lower levels in the MACD. So even something like that, where we don't fall as much, is still, that was June, and we talked about, similar to what we're doing here, right? So, but we are still above the 8-day moving average. Remember, we don't really worry about things like this until you break the 17 days. So, and we are well above the 17-day. So we still, even if I were to show you the PPO of how strong we are above that, so come down here, and we are the 17-day exponential moving average. We'll apply that, and let's just get rid of the other MACD and stochastics for now, so we can see it a little bit better. So this is how far above the 17-day moving average we are. We're not as far above as we were earlier on that peak. That looks like to be the peak of this current run, and you can see we can stay above it for quite a while, and it's when you get below it that's when you bring that MACD down, and then you can see over here it was the lowest. That was the furthest below we'd been in the past 6 months. You go back 5 years, and you can see not even close. But we're still, in the past 5 years, the MACD now is still pretty strong, 81%. So that just means, as if we stay riding the 8-day, just don't expect the same kind of move as we got right here. It's just not what we're going to end up getting. We've talked about that directional movement index and the negative. In order for that ADX to get going and reflect the directional move, we need that. The positive is where we want it to be. It's perfect. The negative index is not where we want it to be. And as a result, the black line, the average directional index, is still not able to get going. It's been flat. It got up to 20 over here when we started to get light green shading in the green, or dark green shading in the green line on the market forecast. We got there, but then we weren't able to get going any further, right? We had that good strong move pre and post election, and then we had the vaccine news, and then it was flat as a pancake, right? And now we're just flat with a slight upward bias right now, until that ADX breaks up above. The Ichimoku trend strength, we're rising. We're not above 80. We're not above 5. In fact, this one's not really rising at all. We're just barely getting above 3. 2 is the moderate strength, and we are above that. But again, we are well above that blue line, and it's hard for us to extend away from the green line. It's hard for us to extend too far away when we're that far above the blue line, and when this red line is that far above the price. Right? You can see we're about to be way far above the price. So you can see you can do it for a while, and we culminated there at the end of July. I remember that was this high point, the September peak. By the time we got that September peak, we were well up above price, and eventually we had to pull back, right? Pull back, and that's what that did. So, there's that June peak, right? Here's the June peak over here, plotted 26 days. We were pretty far away from price there too, and you see how we came back down without necessarily getting crazy, but we were well above the blue line. The red line is well above the price. Very similar scenario to what we're currently experiencing. All right, now let's take a look at the intraday chart. Go in the opposite direction. Very small range. Volume dropped off after yesterday's, kind of a little bit of a pickup in volume there. We started to fill in yesterday's gap a little bit with a gap down this morning. We filled in that morning gap. We'll see as of right now, there's only a smidgen of a downturn, but that's it. But you can see we still got the rest of that gap. So that kind of makes that not a breakaway gap, because breakaway gaps don't get filled in at all. So the fact that we came down into it suggests, all right, maybe this isn't the breakaway. So there's a good chance the rest of that fills in at some point. It doesn't have to be tomorrow. Pretty decent chance it could be tomorrow or the day after. By the end of the week, we could fill that in. If not, this one as well, basically down to the 355. That's kind of where I expect the next near-term pullback to get to. Right when we, the next time the blue line drops below 50, as you can see, it oscillates up and down. That's kind of where, that would be down to 355 would be kind of in this area here, down to that, pretty much the low point of the divergence, in between the two divergent high points. So that's kind of my expectation. We'll see if it happens or not. But you can see also too, if we break the midpoint, which is 350, and there's some pretty decent support in that area, so it's not going to be easy. And eventually, within a few days, the low of the 4-week range is going to be there. So unless we get a new high that expands it out more, but but if we break that, you can see there's not very much volume down below that at all. If I were to expand it out, 30 days, then you can see a little bit more of a chunk right here, about 345. There's that 350 range, 345. You can see kind of if we break the 355, it kind of suggests that 345 might be the next area where we find some support. And if I go out even further to like a 90-day level, there's a 90 days. So 355 being in this spot right there. There's 350, a little bit of a node, 345. So it's really, we've gone up so much. Bulk of the volume in the last 90 days is way down here at 340. So, but the value area is also right around that 355 area. So that's kind of like the more likely. If, we probably won't fill in any of these gaps until we get, if and when we get the next intermediate, right, where the green line on the market forecast drops below 50. So, but that's kind of what I expect on the next near-term pullback. If you take a look at today's range and volume, very minuscule. Like after 2 days of pretty decent volume, nothing. Right? We dropped down. We barely had as much volume today here at 45 million that we had the day before Thanksgiving. Right? That Wednesday when it was like as flat as a pancake, our range was 1.68 points. Well, the range now today was 2.76. So very small range, very, it's one thing to have like a 1% range, and it's maybe a little smaller than that, but, we're just not, we're really coming down to some lows, and we did that in September too, and that's where we found support. We didn't break the 1% mark. We found some support there and bounced off of that back up to the 2% level, and the ATR was lower then than it is now, and on an absolute basis, we're higher now, so that's why the average is the more important number. The volume is a little bit higher than it was back then. But if you look at the VIX is, here we go. So going into that, oops, not that one, this one. Going into that September peak, you can see that the VIX was trading in the kind of the low mid 20s before we started to ramp up. Now we're a little bit lower. But back then, we were extremely low in volatility in the 80% mark. Here, we appear to be getting to the 85% mark and not able to get any lower. In fact, we kind of rallied into the end of the day today. It's still not on the... There we go. Better. So you can kind of compare how we were going into September. But it appears that the volatility index is hitting that 20 level as a support. And one thing too that really stands out to me on volatility and something to keep an eye on is that you notice after getting some really big ranges here, the ranges that, here the last week of October, the range of volatility was 12 points. I'm looking up here at the top left next to that R number up there. The range there was 14 points and it was all downhill. Then we went down to less than 5 points. We went to less than 3 points, less than 5 points, and now so far this week with 2 days left, less than 3 points. So we're really grinding, very similar to what we did going into that September peak, grinding with multiple weeks of very small ranges. And that's one thing to have very small ranges below 15, below 20, and especially below 15, because it can't go very much lower, and obviously it's not bouncing up either. So it's one thing to have very small ranges like that over here. It's another thing to have very small ranges like that here, like above 20. So, that opens up the possibility, especially after multiple weeks of very small ranges, it opens up the possibility that we get a week like this. And you see, it's only 1 week. It's only 1 week there. It's only 1 week there. So we're not like, you can see some other examples. A few weeks there in 2018, we had that bad quarter, and a couple of weeks there. But that's it, right? It's usually just 1 week, and then we pull back down. So when's the next time we get the 1 week? And you can see the storm clouds are kind of forming there with the very small compression on volatility. It's like a coiled spring, potential energy building up here. And you're not going to get one of these kind of candles to the downside, not without one of the you can notice the big downward moves come after the big spikes, right? That's when the big downward moves come. So now that we're here, we kind of need something like this so that we can get the big candle. I mean, it only gets up to about 30, but then we get the big candles that get you back below 20. Now we're not getting a big candle to get us below 20. They're too small. So that's kind of why I say expect a little bit of a spike here pretty soon. I just don't know when, right? When's it going to be that 1 week that this comes out of nowhere? The only thing that we can anticipate, because volatility is so unpredictable, is the compression, which is the really small ranges over time. If you look at the monthly chart for volatility, if you look at the monthly chart here, then you can see very big monthly range in November, but remember most of that was actually in the beginning of November. So especially once you got to November expiration, now we don't have very much of a range at all. But really by the time you got to about the middle of November, so November 13th especially, then now we don't have very much of a range at all. So if we go into December 13th and we don't get very much lower and we don't pop to the upside, then we'll have a monthly candle with a very tight range. And again, it's like a tornado cloud. We don't know a tornado's going to come out of it, but we can see a tornado cloud and anticipate some bad weather. And that's kind of what we see. That's what the volatility compression is, like a storm cloud. All right, before we shift our focus to other asset classes and our trade idea of the day, just a quick review of the technical outlook. Strongly bullish. The trend is bullish. There's plenty of froth. Froth, that doesn't mean necessarily it will drop tomorrow, but there are storm clouds out there in terms of volatility compressing, in terms of how bullish we are on a long-term basis. It's just a matter of how we manage our risk in this environment. From a long-term perspective, then it doesn't matter, right? A pullback that lasts a month in a worst-case scenario. A year from now, we're not even going to remember it, right? Like, we don't remember, we remember the COVID low, but we don't remember any of the other lows that we had in 2019 because they were intermediate pullbacks, but they weren't significant. We don't remember them now. We won't remember, if we get one here soon, we won't remember it a year from now because, again, long-term expectations are still very strongly bullish. But it doesn't mean in the short term, though, we don't manage our risk and we don't get overly bullish in our active accounts because that's when we can get burned when that 1 week pops out of nowhere for whatever the catalyst is that pops volatility up and it stops us out of, our bullish directional trades, whatever, our short-term trades. when we and if we're overly position size and over risk to the one side in the short term, it can really hurt, even if our long-term portfolio is doing really well during the bullish run. So just keep that in mind. That's kind of my expectations. I expect that we will get some short-term weakness. I don't know if it's going to be by the end of this week. There's a good chance it can be, but I don't know if it will. It might not be next week. We might continue to grind slowly higher, but even with that, you won't see big, strong over positioning on my end and my short term. Not until we get less froth. Then I'm able to do some more directional trades, and we'll be able to build on that in the short term, right? To add to what is a very strongly long-term position. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree, as to why. What are you seeing? What indicators or charts are you looking at that suggest either that you're a lot more bullish than I am or that you're a lot more bearish than I am? All right, if you take a look at now what's the different asset classes and how they're driving, you can see the great returns, again, especially since that September, was it the 24th, the September 24th low point. We've got great returns in some of these areas. And if you take a look here, I tweeted this out when the when we have a close above the monthly upper Bollinger Band, a 5-month return at all-time highs. Was it 5-month return? Yeah, gain 5% or more at all-time highs. You can kind of see what the 1-month returns are, and you can see the 2-month returns. So the 2-month returns, we're talking about 7 times out of 10 we have gains, but on average we're looking at about a 1% gain. We've had a couple really positive returns, but mostly small returns. So if you look at, then you say, okay, here's our returns, 14% over the next, and this is about a 2-month time frame, a little bit more than 2 months. If you say, okay, what's the next 2 months going to look like? And we're going to end up down here in this area, more than likely. Then are we going to continue strong, like this and then pull back down into, or are we going to start down, go up a little, maybe come down and then build back up, which is actually, I think that's the more likely. We continue up a little bit more, then we come down to some kind of level here, probably similar to how bullish we are there, maybe down to, maybe not as much, probably down to like 7% or so. And then we come back up and finish the next 2-month period up 1 or 2%. So, that's kind of like, okay, we have really, 27% returns over 2 months is really strong. 14% for the S&P and 15% for all these other equity asset classes, and commodities really blowing up. And if you notice today, the dollar really broke down to the downside. Really, it was mostly yesterday, but it followed through with that breakdown today with an overbought cluster. That's tremendous. Like, we haven't had an overbought cluster on the euro against the dollar for a very long time, right? You have to go all the way back to these peaks over here when we were on this bullish run, and we're just barely starting an intermediate decline. So something like this, this bullish cluster would be similar to that bullish cluster that we got back here in May of 2017. And you can see how bullish we continued. We were just barely starting. Now, that didn't stop us from pulling back a little bit there and getting light pink shading. So don't be surprised if we don't get something like that, especially if the dollar rallies on any kind of short near-term weakness, or if it turns into anything more than that. And you can also see too, again, let me just show you that PPO because of how fat, whoops, not that one, not momentum, the PPO. And then let's look at how far above the 30-day simple moving average we are. And you notice, we're, relatively high. We've been, had bigger peaks there, had a few other bigger peaks. But outside of those 3 peaks, if you take a look at, we're 2% above it now here. So let me edit that and put it at the 1.97 that we're at right now. We'll just get rid of this one here to avoid confusion. So that's where we're at now. So outside of that peak, which is a huge jump, outside of this, once we started this bullish run, we had that big rally on the dollar here that peaked in June, right? We had that peak in June. We had another peak there, and by the end of August, by the beginning of September, another peak in the euro. These are those two big peaks: the parabolic move on the Russell, the parabolic move on the Nasdaq. Two big peaks there. We also had this one, the pre-COVID. Well, actually, this is the COVID low point. The COVID initially, the euro rallied, and then the dollar took off when risk appetite really hit the fan. But outside of that, you notice that 2% is a pretty strong number, especially when you got a cluster to go with it. So here's again very similar. That's that May 2017 time frame that I talked about before. It's about how bullish we are now, and we had just a little smidgen of a pullback there. But this is the kind of move I expect going into 2021, or however many months it takes. We can just barely be getting started there. But in the very short term, again, it's going to be kind of very hard to extend away from that move. You look at the Ichimoku cloud, which has a lot more relevance in the currency market than it does in the stock market. But you can see we're not as extended away, but we're pretty far extended away there from this price. And then you can also see way far away the blue line, and we're just barely at moderate strength level. We had a very strong trend going. And I go back to that May time frame of 2017 that we talked about before, where we got that cluster right there. You can see, same thing, little bit of weakness was all it took, but we still maintain a very strong trend, and very much, we might pull back a smidgen, and that's all I expect. I don't expect it to be a trend changing in the least bit, and then I expect us to eventually work our way back up into these other areas where this has moved before. In fact, if you look at the longer term chart here, the weekly chart's really bullish. Like, that's a very, very high level. That's about as bullish run that we have. And then there's that May 17th again. We're just kind of getting going, but you can see the weekly is looking very strong, very similar to back over there. So last time we had a very strong bullish trend. Then we have to go back to some of these others, 2007 going into the bear market that we had there, where commodities peaked in the May of 2008. We see something very similar going on with commodity prices too. A breakout up above their Ichimoku cloud and making a run last week with a breakout, and now making a run with a very strong weekly trend going on. You can see on the Bollinger Bands, I mentioned the Euro US dollar, and there's the breakout above the upper band, and a little bit of a breakout above the 100% mark, and away we go, right? That's on the euro. And you look at commodities, here, and you can see the breakout it had. It didn't quite get above the upper band, but you can see it broke through that 0% level, and now it's making a run to try to get up above its 1 year value area and kind of getting going here. Finally, one last thing. That's all inflationary when commodity prices like that go up. There's our 10-year yield, and look at that nice bounce we got yesterday. So we had been pulling back on the yield, and now you see the light pink shading yellow line, big strong bounce back up to dark green shading green line. So very, very bullish for risk appetite to see yields rising, commodities rising, the euro rising, but so strong. The stocks are already so strong that again, it's going to be hard to add to what are already some very strong gains over the last couple of months. For example, over the next couple of months doesn't mean it can't be positive. The average is positive when we've had 2 strong months like this, but we don't get used to another 26% return in the next 2 months. Interestingly enough, you can see since all these little areas kind of peaked here, and it was actually on 11/24 is when they all peaked. We did actually a pretty decent move on the financial sector and the energy sector, but outside of those areas, the other areas that were so bullish, lagging behind: industrials, energy, lagging behind; financials staying relatively strong; materials lagging behind. So now you've got technology and communication services, and up until today, consumer discretionary. Those are your bullish sectors. And I showed you before, when you have those strong bullish, like we had in June, where these small sectors lead, when there is an exhale, they'll be the ones that come down the most, And we saw even during that time, post-June, throughout the month of June, when small cap stocks and industrials and financials dropped so much, technology was actually slightly positive. Not very much, but slightly positive there. So can we get a repeat of that? It's fully expect something like that to happen. For our trade idea today, I want to take a look at the energy sector. You can see energy sector started this period really strong. Probably should have gone from the 25th on, but started this period really strong, pulled back, and then really bounced up today, like more so than any of these others. In fact, if you look at it just today, you can see energy, big time move, and everything else was kind of doing nothing, especially some of these cyclical areas. Big time move in energy stocks. So that's where today's trade idea focuses on. Sorry, I hit the wrong button there. If we take a look at Schlumberger here, SLB, you can see the nice good breakout that it's had dark pink, dark green shading, green line, a little bit of a harami pattern yesterday with that bearish candle. We just barely got an overbought cluster. Again, when we get these overbought clusters at the beginning of intermediate trends, that can be, nothing's 100%, but that can be a really good bullish sign. If you take a look at some of the other charts, obviously we have 3 green arrows. We had when we got the 3 green arrows over here, we got a big, nice jump in volume. That can also signify the potential beginning of trends, of directional moves. You take a look at, getting above 60 over here. We popped up above positive 200 on the initial surge. Very good sign from that perspective. Looking at the 2-line versions, we pulled back to the 8-day moving average. We bounced back up above it. Get some pretty strong momentum right now, but that's okay because if you take a look at the Bollinger Bands, Schlumberger is breaking out, breaking above the value area, and there is no volume in the last year above where we're at right now. So very much a path of least resistance to the upside. Doesn't mean we have to go strongly to the upside all in one fell swoop, but if you take a look at I believe it's the last 5 years, yeah, you can see the gap in volume all the way up to get to about 35. So can we make a next few months a run up to 35? Very much so, according to that. And then it's going to have from 35 to 40, it's going to get a hard time going. But if you break through that, then now, obviously that would take a lot more time, but now you're looking at a move up to 70. Because again, we fell so far so fast with very little volume. Once we fell, then we got here and built up the base of volume there. So same thing here. We fell, then we built up this base of volume that we have since cleared in the last few weeks, and we're really getting going. In fact, if you look at the market forecast for Schlumberger, I can't even say that. You can see we are just starting, dark green shading and a green line. Might get a little bit of a pullback, yes, okay. But what we're going to do for our trade idea is take advantage of some potential strength in that area, and we're going to buy this call option. It would be buy custom with a stop, and set our stop order at half. Excuse me, I did the wrong one. So buy custom with a stop. There we go. So set our stop order at half of that. So it puts us about $100 of risk per contract. Then we'll end up doing about half a normal position, because this is a very directional trade, but we're going to go out in time to give ourselves plenty of time. So that way, if we do get up to 35 by March expiration, if we go through that volume, and we might roll it to future months, but if we get there by March, then we're looking at a $10,000 reward or $5,000 reward for potentially. It says $1,000 here, but if we get stopped out, $500 of risk. So a good 10 to 1 reward to risk ratio if we really kind of get breaking through and filling in that volume gap that I mentioned before. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forum. Open up any new threads. Comment on anybody else's threads. And let's keep this conversation going in between videos. And talk with, keep that conversation going with our community. As always, thank you all very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Remember to also like the tweet and today's Market Outlook tweet and Facebook post. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.